Howdy, Jacob here. Today we're looking at next company in our dividend yield screener of Cohen and Steers, ticker symbol CNS. So we got just over the 4% yield, 4.04. It's a capital markets industry, market cap of roughly 2.8 billion with an enterprise value of 2.5. So more cash on hand than debt, which is good. Total liabilities, no long-term liabilities, just capital leases, pension liabilities, but there's more current assets. I mean, there's more cash on hand and cash equivalents than total liabilities, so that's pretty great for a company. Um, Very consistent earning free cash flow here with little reinvestment just to stay open. um, Consistent earnings. Their earnings appear to be higher though by a little bit. Increase in shares pretty consistently, probably stock-based compensation outflowing, outgrowing the common stock buybacks, which appears to be the case. Um, so that's why we're seeing a little bit of stock increase there. But I mean, this right now looks like a company that's going to be consistent. So, um, yeah, let's start making some assumptions here. So, revenue growth, um, huge return on invested capital. But again, if all you do is pay a dividend with the cash flow that's excess instead of reinvesting it back into yourself, it doesn't mean much. So, not really any premium needed here. I could see this being a 3% growth, pretty much growing with inflation, as they're pretty much a multi asset mutual fund, or they hold multiple multi asset funds. So, um, yeah, 13 on PE because I mean, I see them growing with inflation for quite a bit. I see I mean, I might, yeah, let's do 14 just because if they find a way to invest back into themselves at these rates of returns that are upwards of 30%, I mean, that's just the upward potential of that is massive. So I think that's a fair assumption there. And then as for earnings and free cash flow margin, 28, 23, again, earnings a little bit higher. Um, Okay, shares have been increasing pretty consistently. Let's assume 1%. Let's look at that dividend. How much is it paying out? About $111 million. I mean, that's a lot of their a lot. That's a big payout. Um, I think we're fair to say if they grow 3% a year, they can afford this. They probably can't increase it too much without going into too much debt, but they haven't really been doing that. So um, I guess when they have these big years, they use that excess cash to help pay for any dividends, and they do have some cash on hand, 240 million. Could help pay for a few down years if there are any, but I mean it's a consistent business, which is what people like. Probably why it's a bit farther off than some of the more inconsistent businesses because people can better estimate what the future is going to look like for a business like this. But again, no matter how good the business is, every investment in um, stocks is an investment in the actual company itself, and so um, a consistent company might yield a premium on terminal PE, but everything else is just present value of their earnings and cash. So even if I bump this up to 15 because it's consistent and everything, it still looks like it needs to drop 56% before we get to the 15% yield return that we're looking at. So, um, all right, good review, and I hope everyone has a good rest of their day. Thank you.